we're going to go hard for 20 minutes. And the topic is what basically your clients go through to get a mortgage, and what underwriters look at, and kind of what's the ingredients, because, most people, when they're, younger, starting out, trying to buy their first home, or nobody understands the banking process. So as an advisor, you guys need to know what, your clients are getting ready to go through. So easy. I'm just going to call on my team here to kind of walk it through. And hey, Rick, are you in the downtown office? Which office are you out of? Murfreesboro?
Yeah, I'm at Midtown,
Midtown.
Music Row.
Nice. When did you contract with Northwestern?
Started November, I think 19.
November of 19. Okay, so you've been doing this for a minute.
For a little bit.
Welcome.
Appreciate it.
So I think number one thing we look at, Andy, I'll put you on the hot spot. What's the number one thing that the first thing that the client is going to get inspected if they're thinking about borrowing money and buying a house?
First thing that the underwriter and us or anybody would look at is going to be credit score and what's on a credit report. And so for most folks, that just means filling out necessary information, getting their credit ran. We like to say we obtain the credit report, because that's when we can dive in and really see if buying a house even is in the capability at that point, based off of credit score and what other debt they have.
Right. I'm getting my camera working again. This thing's so damn temperamental. So that's the big thing. Like, we hear everybody say, I don't want my credit pulled, right? And pulled means, like, in the whole world of like how credit monitoring has been presented to people, is that, anytime someone pulls your credit, it lowers. So talk to that real quick.
Yeah, so there's two types of credit scoring, and it's very important to know the difference. There's one model, which is the mortgage model, which is what we use on a day-to-day basis. It's the firm score that's going to represent on a loan app. And then there's consumer credit. So mortgage credit, consumer credit. Consumer credit is what's going to show up on Credit Karma. It's what's going to show up on CreditWise, your bank app. Anything that's popping out a FICO score is essentially monitoring your consumer credit model score. So what people typically see is that when they get an inquiry on their report, that their consumer score goes down. It's like very sensitive to any type of accessing the report or any type of new credit. You're going to see like kind of high and low swings of the score, when in reality, the consumer model is set up that way, where the mortgage model, unless you've ever applied for a mortgage, you actually don't even have a mortgage score yet, because you've never had your credit pulled. And so when people are hesitant about filling out an application and getting their credit ran for the first time, there should be no hesitation, because first of all, they need to establish a mortgage score. And then second of all, the mortgage algorithm is not set up where it's going to go, swing high and low based off of a few inquiries here and there. You can actually get your credit ran pretty much as many times as you want in like a 30-day span, and it's only going to show up as one inquiry. And so it really shouldn't affect your score at all. So that's a huge, demystifying the pulling of the credit, because most people, they're so hesitant to do that. And that's the first and most vital step to getting a pre-approval when preparing for buying a house.
So here's a good quick resource for you guys. My Credit Guy, MY Credit Guy. They're a credit company that we use to help people who have poor credit, or they want to work on their credit scoring manipulation. MyCreditGuy.com. The company is owned by a guy named Sam Parker. He's a friend of mine. I meet him about once a year now since COVID. But he started in credit repair with his wife about 12 years ago, and their only clients are mortgage loan officers. So they only deal with referrals from mortgage lenders. So and they're trying to help the client get a credit score in a range where it would be, acceptable essentially for a certain type of loan. So I think they're a great resource. If you guys have anybody who's talking about credit stuff, I mean, you could almost send them directly there. But I think a lot of times, you know, if it's about getting a mortgage, they're a better resource. And then they're going to say, how did you get our name? They're going to want to try to find the lender that's involved with it. So I just, if you personally, Rick, Matt, anybody on the call, anybody watching this want to go on and look, I think they're a very fair company, and credit repair stuff. All these credit repair law companies, they're kind of sleazy. I've been doing this 28 years, and credit repair gets real dirty real fast, and they make people sign contracts. And then I've had a lot of people that go, God, I did this credit repair company with this law firm, and it was terrible. And they ended up signing some 2-year thing and spent thousands of dollars. So next big thing we look at, Aaron, what your client's going to look at when they get a loan.
Income, that's a big thing.
Income.
So a lot of, especially for first timers starting out or people that don't exactly know, basically there's 2 types of income. If you're an employee of a company, you're a W-2 employee, that's one kind of income. And then under that category, there's different types of income: hourly rates, base salaries, commissions, bonuses, that kind of thing. And then the second piece, or the second type of income, is self-employed income, which typically we're going to calculate directly from 2 years worth of tax returns. So people that have businesses, however they have them set up as Schedule C's on their tax returns, or Schedule E, corporation type things. We're looking at 2 years of tax returns. And I think that's probably the biggest thing that people talk about is self-employed income. And that's like a real scary thing to hear about on the front end. And just what is your actual income, self-employed income, once it's looked at under the mortgage microscope. So every situation is different regarding that. However, basically it comes down to taxable income versus their gross receipts, which is usually the big aha there. But yeah, so income and W-2 income and self-employed income, only 2 types. And then we kind of break down the details from there.
Got it.
I would say this too, on a W-2 income, and I'm just thinking from a perspective of people just kind of thinking, like, hey, what could I qualify for? Just, Saturday afternoon, getting on the internet. In the mortgage world, we look at gross income, meaning income before all the fun deductions like taxes and benefits and stuff like that. So we are looking at a gross taxable income just for the baseline of our debt to income ratio.
Right. So here's the way I think of it when you guys are investment advisors. If you're trying to get your client a disability policy and you send it up to, the underwriters, and they're like, wait, they don't make, 300,000, we're not going to insure them for 25,000 a month if they become disabled. They look up and they whittle down the income and say, hey, we can only get you a $200,000 disability policy based on the income we see. Does that's the only equivalent when I'm thinking about what you guys do on a daily basis versus what we do. When you see that income and it gets whittled down because the consistency over time isn't there. So I tell everybody, every guy on this call, every single person that when we talk about what goes wrong in a mortgage transaction for your guys' clients, it's the calculation of income. I was looking for a little manual, but I have a cheat sheet manual that are like these underwriting manuals that they then do the Cliff Notes. And the Cliff Notes are 200 pages because the real manuals are like thousands of pages to try to figure out. And this is just where people argue, right? This is where most of your clients, if they have some type of thing, and bottom line, you guys, Rick, Matt, you guys going through your own mortgage. I mean, you get W-2 pay off of your statutory employees, then you file Schedule C, and then you have expenses against your Schedule C income, which is your investment. Or you put your W-2 into your Schedule C. I've seen it done so many different ways with the advisors we've helped over time with their mortgages. So cool. Credit, income. Third one, Grant, what's the third one we look at?
Look at assets. So we want to see where is all their money's at. So, number one thing we'll want to ask for will be their bank account. So we want to see that savings account and checking account. We want to see where the deposits came for the last 60 days. So if there's any deposits that are out of the ordinary, we want to make sure that we're asking about those. The next one, obviously from a financial advisor perspective, we're asking for a lot of the investment accounts. So we want to make sure we keep those on file for possible reserve requirements. So when you hop into a lot of the 7-figure loan amounts, a lot of those kind of loans require a lot of reserves. So investment accounts are a great place to have money stuffed away. And then another thing that we're asking for in those assets, and it would be life insurance policies. So especially if they have they can pull cash from those different policies. So credit, income, and assets.
Yep. So with assets, I think the biggest thing that most people, that's the part during a loan where your client's privacy is going to be invaded. You're going to be asked, like, what's this deposit? What's that? And, everybody with a credit report, that's a 5-minute review. With income, pretty much everybody knows they got to show pay stubs and tax returns and, the stuff necessary. The asset piece is always like the sensitive piece because people get persnickety, and it's so important right now because so many loans require reserves after closing. So we're just paper trailing that money. So credit, income, assets. Is there anything else, McCain or, Matt, Rick, anything else you guys seen your clients get asked that, like, if an advisor is watching this on video, especially the newer guys, that they need to know to prep their clients for? And I've got a couple up my sleeve, but I'm just throwing it out there for you guys.
Yeah, I think the overlying question and regardless of where they are as far as income or first home or second home or rental property, which are questions in themselves, is can I afford this? And then not combating, but talking them through the old adage of you have to have 20% down or 15% down or 10% down. And even if they have it, does it make sense to do it? Regardless of what, market interest or prime interest rate is now. I think that's been the overlying theme since mortgages existed. And where the housing market is now, which I know Nashville is high, but I mean, in respective to other markets, we were in Park City, Utah for 3 weeks of July, and like a townhome there is $1 million. You know what I mean? Like it. So if they're Brentwood, Nashville, and they're thinking it's expensive, good for them. But try to go anywhere else that you actually want to live and is as nice as Nashville or Williamson County. But I digress. So those would be the overlying themes, Brendan, that I don't asked a lot or gets brought up a lot, without getting too much into the weeds. And then, really from an advisor standpoint, because like you said, there are shady lenders out there as well, which I know you all are not. And just like when Northwestern Mutual, is preaching, permanent life insurance. Well, I use the analogy all the time. You don't want to be insurance poor, just like you don't want to be house poor.
Right.
Okay. And so it's really leveraging in healthy proportions how much of their cash flow should truly be going to their mortgage, regardless of what they qualify for. So those are just some key points.
Man, you bring up great points. And I think probably the biggest thing I learned early on, this was a long time ago. My first cousin who got me into business, he left mortgages and then started working at Northwestern up in the DC area. And I think just taking that mindset from the very beginning of when a client, they have to go through this credit, income, asset kind of review. But the bigger picture is like, and we call it Smart Start. where we're really kind of asking the questions, especially if they're your clients, like, okay, do you understand the breakdown of principal and interest, right? You know, if you're currently renting for $2,000, what's a $2,800 mortgage payment look like? And you know, what's that going to look like in the new budget? Especially when they're railroading you guys on like, hey, we need to buy, so we're saving up. And you hit the nail on the head with the whole down payment. You know, we want to save 20% to avoid PMI. Matt, we are going to have a call specifically on that. Don't have time today to review it, but that's a huge question. Like, which is better? I always tell people and all the guys on the call, like, you put the options in front of a client, and if you can educate them on the principal reduction, maybe on the tax benefit of owning, if they're married and they exceed the standard deductions to where there's even an additional benefit to borrow money because you get to deduct the interest, and it's, you know, creating a better tax savings. You know, all of it does require time. And it's just like, it's so funny. There was a guy that I referred to a planner just recently, and he called me and he thanked me. And he goes, yeah, man, you know, I'm definitely going to do some whole life, but I've been reading up on the scam of whole life. And I was like, oh, well, tell me about that. And he was like, well, I mean, there's just a lot of, and he goes, but I know it's not a scam. And I was like, it's definitely not, dude. You own your policy. It's a very simple, if you do this, you build this, and over time, your premium, you know, there's dividend payout. It's an asset. It grows tax-free. I mean, it's the most basic form of an investment. And and I said, and should you have all your money in it? No, you should, you know, and this guy doesn't own a home yet. And ironically, he's a realtor. So Matt, I think, you know, to answer the question or to try to put a frame around it, I think a good upfront mortgage meeting, really going through the nuts and bolts, which, believe it or not, even the engineers, when we show them like principal reduction and a tax benefit, and let's say they're a first timer or even a move up buyer, they're like, oh my God, how did I not know this? Truly, it's like, oh, wow, like this is such basic math. So yeah, coupled with what you guys do and kind of our intro meeting where we try to get to the nuts and bolts, I'm always this guy. If the numbers make sense with less down, you have more liquidity. And when you have more liquidity, you're more secure. When you have less liquidity, that's when you have to sell the house. That's when you got to go, you know, call mom and pop, you know, drive to Cleveland and go, please, can I borrow money to get through this? And that's when, you know, we try to look at the whole picture. And every now and again, it's funny. I showed a guy, you know, 5% down versus 20, and it blew his mind. And he goes, do you make more money when you lend me more of a loan? And I was like, well, technically, yes. But like, if we lend you 400,000 versus 500,000, it's not like I'm, you know, paying off my mortgage with the commission check. He was like, but does that mean you're like trying to steer me towards, you know, I was like, no, these are the numbers you pick. So, I think this is the basic stuff, Matt, of just credit, income, and assets. This was kind of a flyover call just to give people context in a short period of time. Rick, you got any questions? Or McCain, anybody want to lob out one more little tidbit? Because I don't want to make this too much longer. I know we've gone for 20 minutes. I want to answer questions. Feel free to chime in.
Nah, I'm good. I mean, I already threw a question in the chat, and then Grant and I already know each other, so I know I can, you know, connect with him.
Oh, there we go. Is there a formula strategy we can use to show a comparison? Great.
Yeah, I was going to say those questions, the items in the chat. I think our last two segments of this training, was it last week we did the PMI that I think we did that, and then the one before was kind of the rent versus own. So I think both of those kind of hit on what they're talking about there.
Yeah, it's, you know, Rick and Matt, every time you guys meet with somebody and, you know, like an hour into your fact finder, or maybe even 2 hours where you're making that headway and you're teaching and it's like, ooh, now I'm teaching and now they're getting it. It's the same for us. You know, it's the same. because I think, us giving you the tools, and to be able to have you guys, it's almost like if someone asked me about life insurance, I'm not going to sit there and try to explain it, but I know the basics because I own it, right? I think the key is to have that tool necessary, or to be able to explain it in such a way where you can grasp it. Because ultimately, if someone said to me, hey, what's your real goal with Northwestern Mutual Advisors? It's simple. We want to help you guys be more financially secure yourselves. Like if I never got to help one more Northwestern Mutual client, but I can only help you guys, and you're like an army. And speaking of which, man, my heart is so heavy based on yesterday. Oh my God. I don't know if you guys know this on my team, but David Knox's 22-year-old son passed away. And I heard the news yesterday morning, and I was driving back from dropping my son at SMU, and I just like kind of broke down. I'm glad I'm off camera. And I don't know David that well. I've met him a couple times through Troy. But man, when a child, 22 years old, he died of a seizure, I guess. Is that correct, Matt? Is that they got him to the hospital? And anyways, it's one of those things where in the end, like helping you guys be more successful, and eventually just helping you understand real estate better, I think makes you better advisors. And if you're a better advisor, people want to work with you more. They don't just look at you as an insurance or an investment person. They look at you guys as a true planner of wealth creation. And that to me involves real estate, and it involves knowing a lot more about mortgages and debt. And we are kind of in an abbreviated way, an extension of you guys whenever you refer us. And so I think the more we understand what you do in Fact Finders, and the more you understand what we do in our Smart Start meetings, the better off we are.
Hey, Brendan, can I say something to that point?
Yeah.
Your role, Brendan or Andy or Rick, like we're talking about the most probably stressful and important thing in people's lives. It's things people are proud of, ashamed of. It causes divorce. We're talking about their money, their finances, right? And so, using David Knox as an example, he made MP in the last couple years. He's got a son in the NFL. His other son's a standout athlete playing D1 football, transferred from Ole Miss to FIU. They have a daughter who plays D1 soccer at Auburn. And so, when we're out there and to the rest of the world, these people look like they don't have any problems and they don't have any tragedy, and nothing can go wrong for people like that, right? And so, but we know different, and we know the nitty gritty. And so just really take that advisor role instead of a salesman role of, just because someone can do something doesn't mean they should. To the point about, just because they qualify for $1 million home doesn't mean they should buy $1 million home.
Mm-hmm.
Just because they could put 20% down doesn't mean they necessarily should. And so I just want to commend everyone who's on this meeting, because I think that's a testament. Like, you want to learn more, and you want to learn the proper way of doing things versus the common way of doing things. So just from my heart to yours, I just felt called to say that.
Well, yeah, thank you, man. I appreciate you guys attending. We're going to wrap up if nobody has any other questions. I don't know next week's calendar, but I think our goal would be to keep filling this. Matt and Rick, we're going to do this every Friday for 20 minutes and then 10 minutes of Q&A. And we've got enough ammo with the questions. Eventually it's going to get to nitty gritty about how to buy investment property, or, we've got one just solely on credit. So me and my team, we decided, hey, this is stuff you guys need to know. We'll build a library. If we get eventually 20, 30 people on the call, and there's people, spread the news, we're going to keep doing it because we know it's valuable to you guys. So appreciate you more than you know for seeing your faces.
Will it be the same link every week and the same time?
Same link
Mm.
every week, same time, 10:30 to 11 is the goal. And to keep it to, start fast, go 20 minutes. And again, we're going to send out the clip. We'll edit the clip and then send it out with the nitty gritty. This time we didn't really have a visual, but over time we're going to have like we'll prep a little visual, maybe 3 to 4 page PDF. That'll be the handout that we'll walk through on the call, especially with like credit repair, so that you guys can have something that if you miss the call and don't want to watch the video and you just want to see the handout, that you'll have it.
Yeah, next
Gotcha.
week is understanding credit and how to rebuild your credit score.
Yeah. And
Okay.
you know, what's funny? I'm going to see if I can get Sam Parker on the call. That'd be fun.
Sweet.
Cool.
Yeah.
All right, guys. Well, have a safe weekend and, keep selling, I guess. Keep
All right.
your spirits up. See ya.
And